Hello everybody and welcome to the latest edition of the True Potential Do More With Your Money podcast. Today we're going to talk all around investment traps to avoid. Got three gentlemen with me today to help me talk through the various trapdoors to watch out for. So we've got Neil Rayner, who's head of our client advice team at head office, Christian Gardner, head of compliance, good compliance though, not bad compliance, and we've got our director of investment strategy. That's a good title, isn't it? Chris Leyland joining us as well. Yeah. So you've all been on the podcast before and you all know the story and what we're here to talk about. And this for me was a good one, actually, not just to be involved with, but working with a team in advance and really just talking about some of the potential traps out there of investment. I think there's a lot of easy headlines, there's a lot of bright lights. It's almost, like the Vegas Strip these days of where to put your money. And we're just going to talk through some of them today of really just the things to be careful of. We're not saying avoid entirely. Some of them might be good short term, they might be good, for the consumer, but in the main we think long term investing is something to be mindful of. So if we just sort of start with probably the biggest one, it's cash in the bank. Some people say cash is king and others say it's not. So let's just kick that one around the table for 5 minutes, gents.
Do you want me to start?
You already have, Chris. So.
I already have. There you go. This I'd say is probably the question that we've been asked the most by end clients, and there's a good reason for it. The reason is that obviously interest rates are much higher than what they were at the start of last year. So what you're seeing is that just in absolute terms, the rates that you can receive on cash are much more attractive than what they were previously. And, I think if we just maybe look at this first chart, what you can see on the first chart here is just the Bank of England base rate, and you can see where we are now, and you can see how that has changed over history overall. But really what you've had is many, many years of very low interest rates, and now what we've seen is interest rates move higher. I guess, what does that mean for cash? And I think it's important. Cash is an asset class. So we invest in cash. We see the fact that yields are higher. Therefore, cash is a more useful asset class for us, certainly compared to what it was, say, 2 years ago when you were earning basically nothing on cash at all. But I think for me, cash is a long-term investment where a client is looking to grow their wealth, but particularly grow their wealth above inflation. I think that's something that is quite challenged. If we look at the next chart, I brought lots of charts with me today. If you look at the next chart, what this shows is from Credit Suisse, and it shows the relative returns above cash since 1900 for different asset classes. So the reason why it's such a long time period is so we don't cherry pick a certain period when interest rates were really low. So equities have provided 6% a year above cash on a per annum basis since 1900 overall. So it just shows just how important it is to be invested over the long term and actually the returns that you can potentially receive. And I think, the other thing that is in the background, and I know it's something that we discuss a lot on these podcasts, is inflation. If we look at where inflation is right now in the UK, it's significantly higher than any rate that you can get on cash. So the one thing that you're guaranteeing is if you say, right, do you know what, I'm going to put X amount of money into cash, I'm going to lock it in for 1 year, then actually in real terms, you're going to lose money on that cash overall. So I think for me, cash is important. It's an important thing to have as a client, as a source of short-term money. It's important for us within the portfolios to have access to cash. It's something that we use a lot. Is it something that I would have as a long-term investment that I think would be inflation beating over the long term? I don't.
I think you've made some great points there, Chris, particularly that cash has a place in every portfolio.
Yeah.
We know that we recommend clients have 3 to 6 months cash on deposit as an emergency fund, as a key staple to make sure, should the unexpected happen, you've got enough there. I think all of our portfolios have cash in to some extent.
Absolutely, yeah.
If you look at the very low risk, 25 to 30% probably, going up to maybe 1% in the aggressive. So the key is every portfolio has a bit of everything, and don't put all your eggs into one basket. We've had a lot of questions as well from clients saying, the returns from cash are better. I haven't seen much on my portfolios over the last 12 to 18 months. should I be moving into cash? And I think it's a very short-term view. Yes, interest rates have increased, but as you said, Chris, if we look at the long-term returns from other asset classes such as equities, such as bonds, they also provide very good returns. And I think for those clients who are looking at the interest rates now, again, you've got to remember it's often a headline rate. So normally you're putting cash in the bank outside of an investment wrapper. If you're a basic rate taxpayer, 5% might look great, but you're only going to get 4%. And if you're a higher rate taxpayer, that drops to 3% once you've paid out your tax. And I think, Neil, you were discussing some stats earlier on about how many clients might be caught out by the increase in tax on interest.
So, you know, we talk about headline rates, and we talk about there's a big competition at the moment, I would imagine, between banks to offer and attract clients over, such as Chase or First Direct or whoever that may be. And they are very much headline rates. And what clients are seeing from a media point of view or from an advert point of view, they're saying, well, I can get 4%, I can get 5% in the bank. But this is very short term, we feel, with regards to where inflation is going and potentially, obviously, interest rates as well. So if you think about your pension, which is very, very long term, you wouldn't want to be sat in cash for a great amount of time. We always do, like Christian correctly said, we always recommend you have an emergency fund where you've got that bit of cash you can grab in case anything goes wrong. But when we're talking about your goals, your financial goals, it's very important to take a longer term approach. And this is what we discuss with clients on a day-by-day basis. A lot of people don't realise as well that the money that you have in the bank, you have an allowance where you're allowed to earn so much of savings interest as a buffer. Over then, it's going to be added onto your income. And there will be a lot of clients who don't realise that if they've got significant savings in the bank, they're going to have to declare that annually on their tax return, and that will be added onto their income above what is quite a small allowance, £1,000 for basic investors and £500 for higher rate taxpayers. So you're not getting a great deal of savings allowance there, and anything over that is added onto your income. And if you're a basic rate, it's charged at 20%, and if you're a higher rate, it's charged at 40 as well.
And that, of course, has to be reported by self-assessment.
Correct.
Which puts a huge liability on you. It's a complex thing to do, or you have to pay an accountant to do it. So again, you're incurring additional costs there. And it's a tax trap that I think a lot of people will be caught by. And the last thing, of course, you want is to have a load of unpaid tax, which HMRC realise in a couple of years' time, and then you end up with a fine for not completing a self-assessment.
Absolutely. And I think on cash as well, I'm going to chip in on this one. I know I said I was going to leave it to you experts, but our platform as well, our sort of technology platform, allows clients to be 100% invest. And quite startling when we look across our industry, our peers don't have that capability. So actually in a growing market, they have cash that's not doing anything other than paying fees to the provider, the financial advisor, or whatever it may be. And that's a mandatory cash account. So in a growing market, you might have 7% of your money working for you, but you've got maybe 3 to 4% working against you as dormant cash. Obviously ourselves, putting clients first. When Chris invests the money, it's 100% invested at portfolio level, and we let the cash do the work and within the portfolio. So a big differential really. And I know, Neil, when we speak to clients, it's not probably something we talk too much about, that importance of having all of your money working for you all of the time.
From a financial advice point of view, as I said before, I mean, we always recommend you have that rainy day fund, but the way that the diversification works within the portfolios, managed between different asset classes, that's a longer term bet, and the diversification really kicks in with that. But a lot of clients, as I said before, aren't aware that whatever they've got accruing in their savings at a fixed rate of 4%, 4.5%, 5%, they're going to be probably paying, some sort of tax on that towards the end of the financial year.
And I think, as we always talk about, it's important to think about the long-term returns. Many of the people we've spoken to are pension holders who've been investing since the 60s or the 70s. And if you look back, you've had very good returns from a diversified portfolio, and you don't want to jump into a short-term opportunity that could cause you a long-term pain, which is what we're going to be talking about obviously later in this podcast.
Yeah, correct. Well, I'm going to take us on to the next category, which is actually a strange one, because I think you'd have to have lived under a rock not to have come across cryptocurrency. I think it's a broad term that covers a lot of different unregulated beasts really in there, because I know from, say, some of the chaps I speak to down at the pub, they're all showing me their crypto wallets, and it's got not even enough money to buy a beer in it. So it's a tricky market, isn't it? It's a tricky one to put your finger on and describe. But let's just quickly summarise what is a cryptocurrency.
Do you want to go for that one, Chris?
Yeah, so basically a cryptocurrency is an electronic way to facilitate a payment between two people. So it's not a traditional currency in any way, and basically it's valued from a supply and demand perspective. So when you see the big ups in cryptocurrency, that's kind of speculative demand coming through. Obviously, you've seen the big falls where you see that sell-off come through. It's very hard to store. So obviously you don't have like a note for a certain amount of cryptocurrency. You have to mine cryptocurrency as well, which from an environmental perspective is very bad for the environment overall. I think for me, cryptocurrency probably don't get asked as much about it now, because after you saw the big fall in crypto that we saw with say the Bitcoin price, the reason, so we don't hold any type of cryptocurrency in the True Potential portfolio proposition, and there's one reason why we don't have that. It's because it's so volatile. So if you look, the figures we last ran this, it had around about, I think it was 8 times the volatility of a global equity. Now that for me is incredibly difficult to put into a portfolio. So to size that position without that position dominating the whole of the portfolio return is impossible. And then I think the second thing is, how do you value it? What's it used for? The main thing it was used for was to allow people to buy things that they probably shouldn't have been allowed to buy as a starting point. And then the second point around, there's no real way of valuing it. It doesn't have an income stream or anything like that, like a kind of traditional investment would do. So you can't value it in that way. So for me, it's pure speculation, and that's not something that I want in the portfolios.
It's a good point, and with Chris has mentioned 2 good words there: pure speculation. If you have a think about a client, that for us means extremely high risk and volatility. And when you're talking about the investment vehicles, Chris said it's not in the portfolios for the obvious reasons, but if you have a look at products, who wants to take that very risky approach with their future pension provision? Clients don't and shouldn't be taking that risk, and a lot of them we've seen some horror stories in the press of people buying in a large amounts, and then you've had a dip, and that could be your future provision.
It is.
It's literally, for me, it's like betting on a horse. You've got, admittedly, some people are good at betting on horses, and they obviously do a lot of research. But for me, there's nothing behind it. It's pure speculation, and whenever an investment is purely speculative, it tends to be right near the top of its price range, and that's when you start to see it come down.
And then, of course, you've got no regulation.
That's the other thing as well.
It's a really.
I knew you were going to jump in with that, Mr. Compliance.
It's really important to talk about. All the activities we do at True Potential are very strictly regulated. So we have thousands of pages of regulation that we have to read through, abide by. We've got loads of people in compliance teams ensuring that you, Chris, and you, Neil, your advisors are doing the right thing day to day for clients. That just doesn't exist in the cryptocurrency world. So when something goes wrong, you have no protection. And unfortunately, we've actually seen nowadays multi-layered scams where people have lost money in an original scam. They're then contacted by someone pretending to be from a regulatory authority or a crypto exchange saying, we can help you get your money back. You just either need to pay some taxes to release it or go through anti-money laundering. They put more money into the same thing, which is just another scam run by the same people.
And I think a lot of it as well has been fueled by social media.
Absolutely.
And what you will see is great success stories, but you won't see the majority of the horror stories where people.
Well, I like Chris's definition of it. Betting on a horse race, but the race never takes place. And there's a man with Twitter or whatever it's called these days who can post something and drastically affect the market value overnight. It's it's that horrifying. So I think we've all ruled that one out. Is maybe if you want a little bit of put a pound in and see where it goes, but certainly not your pension, your ISA, your serious money. It's just not to be played with, is it?
I think one of the key points on the vol that you talked about there, Chris, is actually when you think about if you lose 50% of your money, you have to grow by 100% to get it back.
Mhm.
So if you look at Bitcoin down from its peak, it's down about 80%. So you've
Yeah.
then got to have 450% growth just
To
to
get
get back to where you
were,
were.
yeah.
So you actually, you might see in Bitcoin this year, people go, oh, it's gone up by 100%, but you're still a very, very long way
Correct.
from the peak.
Getting anywhere near.
Yeah.
And this one came up on the list. Now, I'd never really considered this one, and I don't know if it's my age or what have you, but coins and gold and art and artifacts and all kinds of bits and pieces, which are viable investment solutions. And I'm not as the notes say here, daytime TV. I don't have time to watch daytime TV, but my wife, who's at home on maternity, tells me there's lots of adverts during the day. So where does this sit within, Chris, the investments? Jen's giving advice. What are we thinking with gold and coins? And
again, you've got no regulation.
Mhm.
And one of the key things I'd say is, if it was such a good investment, why would someone sell it to you? Why would they go through all the effort and cost of doing TV advertising to then post a coin out to you? If it was going to grow in value so much, surely you'd just keep it.
Yeah.
So
Even if it's got, the king's head on it, and it's
even if
a special edition,
if it's the new
there's only 100
11-sided
yeah.
coin,
yeah,
is there really going to be a market for that in the future?
but
That's
there's
the
only
key
10
question.
produced. Should we still be mindful?
The problem is you've got to find a market for it. And again,
Yeah.
with regulated investments, there's always a market. There's pension funds. There's other investors that want to buy things.
I think as well, there's if you're going to put all your money in crypto, you're going to put all your money in rare coins and gold. There's a concentration risk. And
Yeah.
we keep talking about diversification, but diversification in regulated products, not in unregulated products.
I mean, one would so we don't hold any rare coins within the True Potential portfolio proposition.
Interesting.
We do hold gold.
Yep.
So we hold physical gold ETFs. We hold gold mining companies as well. So we do have products that track the gold price.
Yeah.
They're obviously very highly regulated. They're some of the biggest products that are out there right now. I think gold is a useful diversifier.
Mhm.
I think it's an interesting tool to have in the portfolios. Got probably around about just over 1% in the balanced portfolio right now. But as far as everything else goes, kind of rare coins, again, things like how do you value them on a daily basis? Don't know. What's the market? Again, like Christine was saying, where are the buyers? Where are the sellers? How do you bring that together? There just isn't any of that.
Yeah.
And there's a key distinction between us holding physical gold, which has a price and is
Yeah.
traded, and whilst a coin might be made of gold, you would pay significantly more than the value of the weight of that metal.
Absolutely, yeah. No, good point.
Dead right. So again, we're sort of saying
We're going through loads of negative
gold's-
ones here.
well, Neil mentioned it. You don't want too much concentration on one thing.
Absolutely, yeah.
And you answered the question I was going to pose to you on behalf of our clients, which is 1% of the balanced portfolio has, exposure. So you're getting a bit of it. You're getting, some exposure, but you're not all in on gold, for example, which is important. Isn't
I
it?
think as well, you can generally look at the areas. If you talk about crypto, if you talk about other investments, the major thing to look at for a client who wants a steady return on their investments and is in regulated versus non-regulated. We're talking about non-regulated areas, whereas all the investments that True Potential offer are regulated, and that's where you get the safety. That's where things are properly governed.
Yeah. And then next up, property, which is slightly more favourable, I'd say. I hope we're not going to kick property too much, but some people have, exposure to property. They might have their first home that they're able to keep and buy a new one. I'll look to you first, Neil. What kind of conversations do you have with clients when it comes to
clients
property exposure?
if they've got a bit of cash, they may put a deposit down on the second property and hopefully try and rent that out. But there's a lot of issues there as well now because a lot of yourself, Greg, you've got your buy-to-let sort of properties and stuff like that, and you realise that a lot of it is more hassle nowadays because you've got more tax on it. You've got have you got a guaranteed renter? Is there going to be that stream coming in? And then also as well, you've got the potential of how the housing market is at this moment. Are the properties going to go up? Are they going to go down? Are we seeing a price crash at this moment? We don't know. They have already gone down. Plus as well, would you really want a buy-to-let property with mortgage rates at this moment if you're not going to buy that house outright? So you've not only got to charge the person who's renting the house more rent because you're paying more in an interest rate on a mortgage, and you've got to realistically look at your returns and see if it's worth doing that.
That's a really key point. The cost of borrowing's increased significantly, as we know. So historically, buy-to-lets have been quite attractive when you could get mortgages at 1-2%. Rental increase has been quite significant, particularly during COVID. So there's been a lot of positives for property, but I think you've got to consider the costs, A, for mortgage borrowing, B, maintenance, which is a key thing. You know, we've sometimes seen clients who say, I'm going to keep this buy-to-let property throughout my retirement. Do you really want a tenant ringing you at 3 o'clock in the morning saying, I've got no hot water? Or do you have the additional costs which reduce your returns of having a management company look after it? So there's a lot of considerations there. It can be a good asset class, quite a stable one, good long-term returns, but there's a lot of individual management potential there, whereas with our funds, it's a buy, hold, and everyone else does the work for you.
Yeah, I mean, for us, we hold property, but what we hold is property shares, so property company shares. What we don't hold is direct property, and there's a reason for that, and it's liquidity.
Yeah.
So what do I mean by that? I mean that if we want to be able to sell out of that, we need to be able to sell out of it quickly. Obviously, one of the key things around property is the property market and aligning sellers and buyers. So we hold exposure to property and property prices, but what we don't hold is any kind of physical property, just from a liquidity perspective. It's too hard to get out of.
Yeah, and as Neil said, in that position, I can concur with everything that was said there, because it's certainly not liquid. If you wanted to sell up today, you're talking, months and months down the line of dealing with chains and things falling through and time in the market. You can't get an evaluation. You can have two surveyors come out on the same day and give you £20,000-30,000 difference. It's worth what someone will pay for it at the end of the day. And
I think interest rates have been
yeah.
a key change in that over the last couple of months, certainly, which are going to deter a lot of people from taking those properties out.
And you've also got, of course, potential tax on growth on second properties, so capital gains tax.
Correct.
You can't put them into an ISA or a pension when it's residential property. So again, it might be a good investment now, but any property value growth could then be reduced quite significantly.
Nice segue from DIY of houses to DIY apps. Well done, everybody. This is another thing that's popping up quite a lot, I think, in social media, as Neil said. Advertisements. I think a lot of sports companies now have, a sponsor here or there or anywhere that can get it on their shirts these days of invest and, buy your own funds. And I think the latest one was copy one of our traders, and you think, well, what if they get it wrong? I think these are dreadful. Why would you, in certain parts of your life, you get an expert. If you're buying a house, you get a solicitor. If you're looking for financial advice, speak to an expert. Do you gents agree with that? Or
yeah, I think these, when everyone was sat around in COVID with nothing to do, these really became very popular. Doing a bit of research for this podcast, there was a stat from quite a large trading company which said 70% of DIY investors lose money, and 140% more trades are sold out as a loss position rather than a gain. So there is a lot of risk. But the other thing, again, talking about how well diversified our portfolios are, in these kind of apps, you're investing purely into equities normally, which are volatile. If you invest into one of our portfolios, you're probably going to be maybe 60% equity, 30% bonds, other assets. So there is a lot of risk associated with these, and it takes, in our investment managers around the world with the firms we work with, it's a full-time job researching, investing into one company, and that's not something that people normally have the time or the expertise to do.
Yeah, I think, from my perspective, we've got a True Potential, we've got 18 people on the investment team who are working full-time on the True Potential portfolios. As well as that, we've also got all the managers that we work with, as Christian was saying, all the experts that are sitting around the world. It's not easy to constantly make money in investment. It's actually a very, very difficult thing to do. So in that sense, for me, leave it to professionals. If there's something you're really interested in and you wanted to buy, some Apple shares or something like that, that makes you happy and it's a very small part of your overall total wealth, absolutely no problem with that. But if you're thinking about managing your whole wealth yourself, it really is a full-time job.
Yeah, I was just going to say, I mean, if you looked at, maybe it's our balanced portfolio, roughly in there, it's got around 80,000 holdings, around about that. If you invest directly in one share, you've got one holding.
Mm-hmm.
Now, do you want the percentage of all your money in one holding, or would you rather be diversified and have it across 80,000, where if one particular area takes a hit or is going down or is volatile, you've got a hell of a lot more to diversify and keep your money, where it is.
And there was a real issue with financial advisors probably back in the early 2000s recommending pension transfers that were just put into cash for clients to self-invest. And that led to a lot of money going missing through unregulated investments and a lot of money lost by going into high-risk, unsuitable investments. So there was a huge crackdown from the regulator on that. And we can't recommend now a client self-invests purely because of the risks involved in it.
Yeah.
Rightly so. Yeah. Rightly so, I think. And on these sort of DIY and crypto and all the other things, I scribbled a note down to remind myself, but you watch the advertisements, you see it almost everywhere you look. It's always a younger person who looks like they're having a great time.
Yeah.
They're
like a Lamborghini in the background.
But they're at with a put in the pub, they're going, look what I've just done, and it's like, that's not what it looks like in real life.
Yeah.
It's probably somebody really upset.
Yeah.
They've probably lost money. The stat you've just said there, Christian, likely they'd be one of those people where they're not having fun at all. The advertisements are allowed to show that because it's not being regulated as heavy as, say, what we are.
Yeah, so people will see this successful guy with a Porsche in the background in a pub. It's not your weekend, by the way. But they'll see this image and they'll think, wow, that guy's successful and he's made so much money, and he'll show you how much money he's made. And it's rubbish.
There was actually new guidance issued by the FCA just in mid-June on finfluencers. So, social media. And there's specific rules, and the FCA are now targeting them. But one of the funny things in those photos you mentioned, they quite often have huge piles of cash. But you don't make cash.
No.
They've actually gone and withdrawn that from the bank. Yeah. It's not like they've suddenly, someone's posted them a huge load of £20 notes. Yeah. And it's all just designed to entice you into it. Yeah. And it's normally these people getting fees for referring people into schemes as opposed to making actual money from the investments.
Yes. Yeah. And who said that is Porsche in the background? It can be made up.
Probably hired.
Correct.
At least for the day. Right, we'll quickly... We half covered this earlier, but stealth taxes and hidden taxes and things to look out for and all the rest of it. Who wants to quickly summarise that?
I think most of what we've talked about today is investments that could result in incurring a tax liability. We've got cash savings, which if you go over your normal allowance, you're going to result in additional income tax. But it's key to remember that those tax thresholds have now been frozen. So most thresholds are frozen till 2028. So whilst everyone's in a high inflation environment, everyone's asking for pay rises, that's just resulting in everyone else paying more tax because those thresholds aren't increasing at the same rate. There's a lot of government spending going on. We've seen it through COVID. Yeah. We've seen, public sector pay rises, and that money has to come from somewhere. Yeah. And part of that is tax freezes and probably likely future tax increases in percentages. There's the long-running conversation about capital gains tax. Will that eventually be equalised with income tax? And it's really important to think not only about where you're investing your money, but how you're investing it through a tax wrapper, through a pension or an ISA, which over the long term can result in a huge amount of savings.
Yeah, it's a good point. I mean, if you're filling up your ISA allowance, or you're putting in £100 a month or whatever that may be, and you think, I'm seeing 4.5-5% in the bank. Well, think about that ISA. When you come to take money out of that ISA, it's income tax and capital gains tax free.
Exactly.
Whereas if it's in the bank, potentially, you will be doing a self-assessment and adding on to your income. So there are tax benefits to stay within those traditional products.
Good. Well, look, let's wrap things up. I was going to say let's give tips, but thankfully they've all been written down for us on this crib sheet that we've got in advance from our helpful team. But I think what can people do who've listened to today's panel? They're thinking about investing in maybe one of the things we've talked about, or indeed they're looking to open up an investment. What do we think they should be doing? No, looking at you.
I think the most important thing is check it's a regulated investment and look into things carefully. Yeah. So I saw an advert the other week for an investment into a car, a fractional investment into a Ferrari 550, and the disclaimer was all about the firm is regulated by the FCA. but the investment itself isn't.
Isn't, yeah.
And that's a really key point. So look beyond the small print sometimes and check that you know exactly what you're doing and what regulatory protection you have in place should
Yeah.
something go wrong.
And how would you go about checking? Where would you check?
You can check the FCA register.
Yep.
If you're concerned about anything, consult with a financial advisor, or there's a lot of government schemes as well where you can ring up pension-wise, etc., Money Helper, and they can
Yep.
give you guidance as well if needed.
Yeah.
Yeah.
And if you're one of our central clients, ring us up
Yeah.
and ask us, because we're the experts here at True Potential.
Yes. Chris?
I just echo what they're saying. Basically, consult a financial advisor. Make sure that what you're investing in is FCA regulated, and
Yep.
do your own research as well. Spend a bit of time looking on the website, the brochures, the fact sheets. We produce so much information. Look at it, read through it, make sure that you're comfortable with it, make sure that as much as possible you understand it. If you don't, again, speak to a financial advisor.
Absolutely. Well, gents, thank you very much. I think
Thank you.
we've hopefully given our viewers a little bit to take in, understand, but mainly do a bit of research if you're unsure.
Yep.
So, thank you.
Thank you.
Well, thank you everybody for staying the course. We do hope you enjoyed today's session. As ever, please do remember to like the video and also subscribe for more viewing from ourselves. Thank you.